Hello, good evening, everyone. We are 7 minutes to 7 p.m. So let's give some time and welcome to this SIAS session. So today we have Ben and myself and our crew here. So I think given that we have another 7 minutes more to go, please feel free to, if you have any questions, feel free to comment into the chat box, and we'll be glad, more than happy to answer them if you have any questions.
Right, so evening, ladies and gentlemen. So we do not, or rather we did not have any pre-submitted question. So, we welcome any questions that you may have. Yes, so we have got one from me to me. Right. Yeah. So that's great. All right. So we do want to hear your questions, and that is why this session has been set up. So if you did not pre-submit a question, that's entirely fine. All right. So there was a question here. Do I ever use derivatives like DLC options, warrants to hedge against losses, or will it be simpler to just cut loss or buy more later? I guess the question is, should we as retail investors, uh, should we use options to hedge? All right, just
Mm.
okay. So I think that's a very pertinent question, especially because SGX has got a lot more products nowadays. So they got futures, options, structured warrants, so on and so forth, and also they've got all the traditional Simsky futures contracts. Now, the question I always ask is, do we as retail investors, do we actually operate on the same level playing field as the institutional investors? Because you see, we are in Singapore, right? So when we go and sleep, the US is open. And normally what happens is that a lot of the market moving news happens when we are sleeping. So if we do have an open derivatives position and we're sleeping and something happens, we may or may not be able to change our position in time. So obviously, it also depends on the broker that you have. So you can put in, orders, contingent orders, so that if the markets go up very high, automatically it'll sell for you and you capture the profit. Or the market drops, then of course you'll cut loss and then you get out. You can do that, okay? But I personally don't do that simply because the amount of value that I have at risk is very low. So, I'm not trading millions of, I don't have a position of millions of dollars. So I don't really hedge. And the thing is that hedging is expensive because if you want to buy, let's say, put options, or you want to short sell call options to guard on the downside, it actually costs money. Yeah. So options are like insurance. It's not free. It costs money. And when times are very volatile, for example, like when the market is you check the VIX and the VIX index is very high. Normally, the option prices are also going to be, more expensive. So for me, I don't do that. All right.
Yeah, maybe Ben, maybe I just add on to your point. I guess maybe we just take a step back. I think it'll be better if the person who raised the question, what are you trying to hedge against? So I think taking a step back, asking that question first, perhaps you could actually find natural hedges. I mean, like finding a stock that may be less correlated. That could be a good hedge rather than really dabbling into derivatives itself. So I mean, that is something we could consider. But first, you need to ask yourself, what are you trying to hedge against? I think that will be a more interesting way to think about before whether you want to engage into derivatives.
The other thing about derivatives in Singapore, it's you need a different account.
Hmm.
For example, you have got your stock trading account, and then you've got your derivatives trading account. If you go to the local brokers, normally you have got two different logins because two different platforms. That may not be true for Saxo or Interactive Brokers or some of these foreign platforms. so that's operationally an issue as well, because if you want to hedge, you need to see what's your stock position, and then you need to have your derivatives position as well, right? So you got two different logins and all that. So it could be a hassle. So generally, I don't. All right. So for those of you who has just joined, this is the SIAS session. This has when we first set up in December, this is really a forum for you to ask questions. We did not have any pre-submitted questions, so we're hoping that for those of you on the call, you can, whatever question you may have, you can type in a chat and then we'll answer as best as we can. All right. Just to make sure that everybody is on the same page, this is a different type of seminar from the Monday market review. All right. So for those of you who want us to comment on, market movement for the week that just passed, that's the Monday session. All right. This one is more like a Q&A. Whatever you want to ask, we will try to answer it. All right. So that's why we've already started, simply because there were no pre-submitted questions. So we did not have any predefined talking points. So whatever you want to ask, just shoot, and then we'll answer it. So we have another question. Is it a good time to buy high-yield foreign government bonds with high yields and risk? If yes, then what duration is best? 2 to 5 years or 5 to 10 years? Okay, I guess one thing we need to start off with is that we need to understand why the government bond yields are getting higher. It's because of the so-called reflation trade, right? So you have got fears about inflation increasing higher. So previously, the world kind of expected inflation to grow at a certain rate, and now because of the snapback in the global economy, and the US is coming back, so on and so forth, and you've got all this pent-up demand. So now the concern is that the growth of inflation will be higher than normal. And when there's high inflation, people don't like to buy bonds because the coupon payments are already fixed. So if you're getting 2% a year and inflation is already 2%, that means your bonds don't make you any money. So people are selling bonds. So when people are selling bonds, price of bonds drop, therefore the bond yields go up. Yeah. So that's the mechanics behind the between yields as well as prices. So coming back to this question, I think it is possible to kind of choose a relatively good yield or good government bonds to invest in, but then it could still come out with the same issue in that could still face the same issue in terms of if really inflation is growing faster than we had previously expected, then again whatever bond yield that you get, possibly a lot of it will be eaten up by the higher inflation. All right. So in this kind of environment, if you want to buy bonds, I think also can, but you could look at this thing called the inflation protected treasury bonds. So TIPS, Treasury Inflation Protected Securities, TIPS, sorry. That's basically US treasuries traded in the US, but it's inflation protected. So when inflation goes up, the bond yields automatically will be readjusted, and then they'll give you more coupon payments. So it's built into the product itself. So those kinds of products where you can guard against higher inflation, those will also be quite popular. But obviously, these are US treasuries, US government bonds. So the yields will be good, all right? But of course, will not be as good as some other government bonds because US treasuries are seen as low risk, right? So obviously, if you buy the government bond of a different country, then the country risk might be higher, okay? I think that could be something that you want to look at, TIPS, if you want to get against inflation. But again, you don't want to do a 100% bond portfolio because one of the ways to guard against inflation is, of course, to buy growth stocks as well. All right, and there are a lot of things out there to buy nowadays simply because of market volatility is a little bit cheaper than what you could have bought a couple of weeks ago, and of course. You can buy the sectors which are coming back, like airlines, transportation. Oil already has gone up quite a fair bit, on the average about 20% higher than the beginning of February, so on and so forth. Right, so those will guard against inflation because when inflation goes up, then of course the returns that you get from this sort of asset classes and securities also will go up. All right, so that's a great question, but I think bonds should be seen as part and parcel of a holistic portfolio rather than by itself. Okay. Now, what's the next question. Oh, okay. Sorry, you had a second part. The duration, 2, 5, or 10 years. Generally speaking, the higher the duration is, the more sensitive it is to interest rate changes. So if you want to have a little bit more volatility, as in you're willing to have the price of the bonds go up and down a little bit more, then of course the ones with the longer tenure would be your thing. All right. But again, if you're going to be buying bonds just to collect coupons and you have a fixed exit strategy, like you want to buy something in 5 years, you're going to buy a car in 5 years, then obviously you want to match the tenure of the bond to your potential liability in the future. All right. So that's a great question as well. Okay. ARC investment. Sorry, where's ARC?
Katie Wood, the innovation fund that they have. So I think it touts itself to be they invest into the frontier technology and stuff. So I think they have large holdings of Tesla, large holding of Bitcoin, and
this is SPAC, is it? The Special Purpose Acquisition Company?
Not really. So it is I think a fund management company. So I think based on my understanding, I think the CEO or the founder, Katie Wood, is just as charismatic as your favorite, Elon Musk. So so I think they have a couple of funds, and the target is really to invest into the technology of the future. So I think biotech, autonomous vehicle, EV, Bitcoin, these are the things that they are looking at. And I think their fund has done relatively well over the past, I think last year, given that how much the technology stocks. I mean, if you have Tesla, you have Bitcoin, your portfolio would have done as good as well. So I think their technology, or rather their vision, is really something that I think is interesting. So I myself, I pivot off this PDF that they released, the Big Ideas 2021. So I think in itself, they have things like Tesla, they have things like Bitcoin, drones, 3D printing, biotech and stuff. But then again, maybe it really depends on your investment horizon and your risk tolerance, because some of this, like R&D, it could go either way, right? So it could be really like your future. You are looking at 2020, 2030, 2040, 2050, or it could go the other way around, where it could be just like Bitcoin lah. Using Bitcoin as an example. So it really boils down to how you perceive of its future. So some of the ideas are really very interesting. So I think for the audience out there, you could just simply type ARC investment and just talk about the big ideas. You can get some ideas from there lah. I think they also allow you to subscribe to their daily flows and stuff, and see how what they have invested or divested over the day. So I have some friends who mirror their trade. So but then again, these are huge players, right? They do in millions and billions. So if you are really that convinced with these teams, these futuristic teams, then perhaps you could consider them lah. But then again, your risk tolerance and your investment horizon ought to be taken into consideration as well.
But where's the performance? I'm looking at the website. Where's the performance data?
So if you go, I think you could go to the ETF name is ARKK. So
okay, they go unit trust funds.
Yep.
Mutual trust funds.
ETF arrangement. So
yeah. Okay. All right. So a couple of things. I don't know this company. One thing is, of course, where the heck is the performance data? If you're a unit, mutual trust fund, you should have it somewhere. But I can't find it on the website. So I guess for us in Singapore, the main things would be the ETFs as well as the mutual trust funds. Right. So mutual trust funds are the same as unit trust funds. But I guess ETF would be easier for us to access in Singapore. Again, one challenge here is that ETF is actually actively managed. It's not. I don't think it's according to any kind of index. All right. So that means it's basically a unit trust fund because it's actively managed. For example, if you look at the S&P 500 ETF, it basically mirrors the S&P 500 index. So if it goes up by 5%, the ETF will go up by somewhere very close to 5%. But I think this one is actively managed. Nothing wrong with actively managed ETFs, but personally, I think that is like, you know, calling a cupcake apple pie. You know, this is two different things. I mean, this is really actively managed ETFs kind of misses the boat when it comes to the whole point of ETFs, because ETFs are supposed to be passively managed. Because if I want something that mirrors the index or whatever, then I just go and get ETF. It's a no-brainer because I want to bet on markets, right? So if this is actively managed, then what's the difference between that and the unit trust funds? Obviously, it's going to be cheaper. It's more accessible because it's on a stock exchange. But the problem is that if it's actively managed, then what do I compare it against? What's the benchmark? If you think about it, this is nothing. Okay, I mean, I'm going to play the devil's advocate here. If you guys are like my age, then of course you will have gone through the .com crisis and all that. And then, you know, if you remember 1999, year 2000, you know, the whole was talking about the internet and this, whatever, you know, that's happening and all that. And everybody went to buy the Henderson Technology Fund. You know, Henderson, they're still around, right? But last time Henderson was very big, and then after a few months, it crashed, right? Like you get back half the money. So obviously, at that point in time, we were talking about websites and all that, you know, Internet 2.0 and all that, and do commerce. Yeah, so now Amazon is a very ubiquitous thing, but last time Internet commerce was brand new. So all these things are next generation Internet, genomic revolution, autonomous tech, robotics, fintech innovation. Yeah, okay. So it sounds like very sexy magic and all that. Okay, until I see the performance data, right? So I'm going to take it with a grain of salt. And I guess this company is relatively new. Is it relatively new?
It is rather new.
Okay, so where's the data? Like, you know, 5, 10 years. How does this compare to Fidelity or basically the Nasdaq ETF? Right.
It was founded in 2014. Yeah.
2014. So it's about 5 years, 5, 6 years. Right. So and also there's one thing here called space exploration. Okay. So
and your favorite Bitcoin. So I think.
Yep. Yeah. All right. So I guess for me, you know, I tend to look at the performance quite closely, and you know, all these you know, very high sounding, sexy sounding terms that you know we just throw around. But I think we've been here before, right? 20 years ago, we were actually at this point. So I'm just gonna play the devil's advocate here, right? So show me the performance data first. All right. Okay. Okay, next we have 3 banks have given their, are we talking about this one? Okay, 3 banks have given their last year results based on the strategies and roadmaps. Which one would perform better? Yeah, I love this question. And my standard answer is, you see, the challenge with all 3 banks in Singapore is that they are about the same. Because they've got the same business model, they face the same risk factors, and they're all regulated in Singapore. Right, so that's why the performance normally are about the same, and all of them have got these, you know, very similar China footprint. You know, some are more exposed, one of them more exposed than the other, so on and so forth, and Australia and all. Yeah. But they're kind of like singing from the same hymn book. All right. So, and if you check, the correlation is normally pretty high. So instead of buying 3, you just choose 2, right? So I wouldn't see as one is dramatically superior than the other, because after a while the correlation is actually very high and you'll probably get about the same place. And if let's say DBS says, oh, we're going to do some write-off because of XYZ reason, then 1 week later UOB will probably say we also need to do a write-off, because you know they have the same business model and all that, right? So I think just choose 2 out of 3 is fine. If you want to choose 1 out of 3, it's even better, because then you can save your money to buy something else which is totally different. Right, but all 3 is kind of okay. DBS obviously is the kind of the National Development Bank, and you know it's partly owned by the Temasek and all that. Yeah, and of course UOB is also pretty strong. But OCBC over the last, and this is a personal thing, OCBC over the last few years have come back very strongly in the sense that they, kind of expanded their product offering, and the service has also gone up quite a fair bit. And of course, you remember a few years ago, they also had this Bank of Singapore, right, which they actually bought over from a foreign bank, right? So they're actually quite strong in that regard as well. I mean, they have a different brand. It's like Toyota and Lexus, right? Lexus is part of Toyota, but it's kind of like the higher end, right? So Bank of Singapore is like the private wealth part of OCBC. So, they're kind of smart enough to actually kind of bifurcate the brand, so on and so forth. But generally speaking, I would just choose one. They're all kind of about the same. You don't want to buy two Singapore banks, because the correlation will be very high. So it's the same as just buying one, right? And then you can use the extra money to go and do something else. Yeah. Okay. Next, we have a question from Karen. Is this the beginning of a big overall bear market or rotation from growth to value stocks? Okay, the first question is this a big overall bear market? I think there are some analysts out there which kind of think that the market might drop by about 10%, but I don't think anybody has written that the market will drop more than 20%. Yeah, so I don't think it's a start of a bear trend. I think if anything, it's actually a start of a I'm not sure whether it's going to be a bull market, but we are at the beginning of the new growth cycle, right? So the US is coming back, China has already come back. So vaccinations are going well. So by the end of 2021, I think things will be much better, and then people will start trying to satisfy their pent-up demand, going out to eat, buying crap stuff, basically spending money, right? So I think this is the beginning of that. I just read today's report. So yesterday, on Monday, we had that market review, weekly market review session, and I kind of mentioned that the Bank of America, I think it was the Bank of America, who the economists kind of forecasted that the US growth rate will be about 6.5% or something like that for 2021, and for 2022, the US growth rate will be forecasted about 5%. That's very strong numbers for the US, right? But I was reading again, a research report today, right, that some analysts kind of think that the number could actually be high. It could be as high as double digit, simply because a lot of the data still have not taken into account the potential latent pent-up demand that's all being locked in. Because you need to remember that a lot of the states in the US are still under lockdown, so on and so forth, right? So they might not have been taken into account. So I think if the kind of midpoint is about 6.5%, and the high point is about 10% growth rate for 2021 in the US, I don't think it's the beginning of the bear market. I think what's happening now is that there is a rotation in the market leadership. But I wouldn't characterize it as a rotation from growth to value stocks. I think it's a rotation from tech to growth stocks. So if you notice, the whole theme during the circuit breaker in 2020, right, was that everybody's staying home, therefore people started logging on to Netflix more and buying stuff on Amazon more, and that's why those companies did very well, right? But so much so that the PE ratios for the valuations for the sort of technology companies became so sky high. And now that the market is reopening, then you have all those beaten down companies that didn't do so well because the focus was on technology. Those guys are getting their lime, they're now the spotlights on them. So it's quite clear that if you look at the performance of the NASDAQ over the last 2 weeks versus the performance of the S&P 500 or even the Russell 2000, the NASDAQ is a laggard. Like, people are going up and the NASDAQ is either running on the same spot or going backwards, right? Or, people are dropping like 0.5% and NASDAQ is dropping by 2%. So there is a change in the leadership of the market, but I think it's from tech to growth rather than growth to value, all right? And when we talk about growth stocks, you'll be things like consumer discretionary sectors. These are the kind of industries that make things you don't really need, like Crocs sandals, Haagen-Dazs ice creams, because you can always get yourself a no-brand China-made rubber sandals and a no-brand ice cream, right? So, like Louis Vuitton bags, Montblanc pants, these are coming back in style simply because, people miss buying things, right? So these are the consumer discretionary. And I think on Monday, we also shared that financials, at least in the US, did very well since the beginning of October 2020. Same for energy, all right? Energy up quite a fair bit. And consumer discretionaries are up, industrial companies in industrial sectors are up, materials is up. The ones which are down, what was it? Utilities, healthcare, as well as consumer staples. Those are the three sectors which basically barely moved. Everybody else was moving faster, but of course, energy was number one, financials number two, and then the rest were somewhere in between. A little bit less in financials, right? So the market rotation is, when this happens, you see this kind of different performances for the different sectors. This is kind of, it's classic. This is like textbook. This usually happens at the beginning of a growth cycle. So I think that's what's happening right now. Don't really foresee a bear market. There could be a little bit of a correction, so maybe because the Nasdaq stocks are, very expensive. But you know what? I think today will be a good day, right? Simply because on Friday it kind of crashed, corrected a little bit, and then today is Wednesday, right? So, or was it Monday? I don't remember. But anyway, yesterday Friday the US market went down quite a fair bit. On Monday it jumped back, right? Yesterday was Tuesday, it kind of moderated a little bit, came down a little bit. But today, if you look at the the Asian markets, Asian stock markets, very strong, right? So you got average between 1 to 2% up across the entire region. If you look at the European markets, which are still open, fairly good as well. The FTSE is up about 1-ish%. The CAG is up, so it's all green. So I would also kind of think that after yesterday's the US stock market today would be pretty healthy. I think I would expect a green score, hopefully. And I think the US futures contracts may be already in green, right?
Yeah, they are trading up, so in green.
Up, right?
But I think the US 10-year is about 1.44 now. So
the 10-year.
Yeah, the 10-year.
Use it. Yep. 1.44. That means same as last week.
Yeah.
Same as Friday. Okay. So I think that today is probably going to be green for the US capital market.
Yeah. So I think all the futures are in green. So but I think there are two things that I think investors need to watch out as well. So I think the 1.9 trillion bill is going to be up for the Senate, and that the Chinese MPC will be held tomorrow. So I mean, these are two events that are worthwhile watching, because I think they will have implications to the wider market. Especially, I think the Chinese made a comment about bubble like sometime on Monday. So I think these are factors worthwhile watching.
Okay. Fair. All right. The next question is it a good time to buy technology stocks now? I think if you're a little bit of a value investor, technology stocks are still quite expensive, but they've been expensive for a long time. But obviously, if you look at the technicals, the MACD, and forget about the MACD, but you look solely at the RSI, it's pretty low. And of course, on Friday, the RSI for Apple hit about 30-ish, right? So that was actually a good time to buy. But of course, by last night, kind of gave up a bit of it. Apple gave, I think it was down by 2%. All right. So I think technology stocks is probably a iffy buy right now. I guess if this is your play money, your mahjong gambling money, then you can buy on dips. All right. But if you're kind of a long-term investor, I think this is pretty expensive. But that's how it is with stocks which are relatively expensive, because they can be very high RSI for a long time. It's a mini bull run. And I think that's what has been happening with the technology stocks since the beginning of the COVID-19 pandemic. But also just keep in mind that the reflation trade is very much in trend. That's why the consumer discretionary stocks seems to be going up at the expense of the technology stocks. Might be a good time to wait a little bit more, I think, for the technology stocks. Next one. What are your views between ETF wrap accounts versus mutual funds wrap accounts? I think the traditional, at least for me, I don't quite like mutual trust funds, because we have I mean, we know what issues are with mutual trust funds because there are only certain times you can buy and sell, and of course there's you need to wait for the prices to be reflected, and they're relatively expensive. Okay, so nowadays mutual trust funds are not so expensive as before. You might not actually have got a fee because maybe your platform actually absorbs the fee. So, for example, I think the last time I checked, if you go to Fund Supermart, some of the funds don't actually have got a sales charge, all right, because that's kind of either absorbed by Fund Supermart or absorbed by the fund manager itself. So it's much better compared to last time. And of course, if you buy a unit trust fund from a bank, then usually there's some kind of sales charge. So just based on the way the product is structured, then I would prefer an ETF ETF product. So regardless of whether it's a wrap account or just a direct, I would prefer ETFs. And the thing is about ETF is that I like it because it's passively managed. So if the ETF is the underlying is the SCI index or the index which tracks a bunch of data centers, I know exactly what I'm buying. But mutual funds is actively traded, right? So it depends on the kung fu of the fund manager and all that. So you need to kind of do some due diligence on the performance data, like 5-10 years. I've been a fund manager myself, so I kind of like, all right, let's forget about all that thing and just go for something very simple like ETFs, because that can mix and match, right? So I can mix a Singapore ETF with a NASDAQ ETF or whatever I want. So I want to maintain the kind of control at a relatively cheap price, right? Instead of having a fund manager do that. Because if you look at it, right, you look at all the performance of all the funds out there, unit trust funds, right, the thousands of funds, right? Generally they don't make more money than the actual ETF or the index, right? And you can check that out. What was the website? S&P 500, S&P Standard & Poor's. Oh, SPIVA, yes, SPIVA, Standard & Poor's index. I think indices versus active or something. So every 6 months or every year, they actually have a report where they compare the performance of the unit trust funds versus very plain vanilla ETFs. And generally, or at least most of the time, the ETF comes out ahead simply because after cost, the return is higher. So I would prefer an ETF-based product rather than a mutual trust fund product.
Yeah, Ben, maybe I just add on to the point that I agree, but I also like to disagree on your point that it is passively managed, because if it is pegged to an index, for example, the S&P 500 index, the index provider do at times take out those less well-performing stock and replace them with and include the more favorable stocks in the indices as well. So the inclusion of Tesla is one example. So to some extent, I wouldn't completely rule out as a passive because simply because the index provider do acknowledge the changes in the market as well, and they incorporate them in their indices. So I agree that ETF is good, but I wouldn't say that it is completely passive nowadays, given that how much these index providers are actually tracking the indices as well.
No, fair enough. Because as fund manager, unless you are what you call a hedge fund, right? So if you're a normal fund manager, you'll probably want to duplicate a lot of the components of the index. Not all of it, because it's actually costly, but you want to have relatively high correlation. So for example, you might duplicate 60-70% of the index components, and then the other 30, that's where you really bet, right? So you might take a larger and proportionate stake in Tesla, for example, because that's will reflect your
conviction,
hypothesis. Okay. Next, what is this? Okay, so I just want to make sure. All right, so can you share some thoughts on the market outlook given the recent rise in bond yields? Are we headed for a significant rise in inflation? I think no. I think the reflation, at least what I found on the internet, the reflation is basically the growth of inflation. Inflation itself is the growth of price level. So we're just saying that inflation will be growing at a higher rate, all right, because of the pent-up demand and economies opening, so on and so forth. I don't think that is a bad thing. I think it's just that it precipitated a change in the market leadership from the very frothy, expensive technology stocks into stock or your companies in sectors which will fare much better when the market reopens. All right, so I don't think that's actually a bad thing. That's actually a good thing, right? But it's just that companies which did very well previously are not going to do so well going forward. There are other better things to buy. Now, whether or not there's a significant rise in inflation, I don't think so, because if you remember in 2009, because of the great financial crisis, globally speaking, most countries had some kind of fiscal or monetary stimulus package, and that actually led to many, many years of very low interest rates, right? So I think that's going to happen as well. And that's especially so in the case of Singapore, because we don't actually control interest rates, we control FX. Right, so our Sing dollar is a managed float regime, right? So MAS will kind of decide the band and then let the Sing dollar kind of float in between, right? So I think we might see slightly higher interest rates, but I think interest rates at absolute level will still be relatively low compared to the traditional 2% or 1.5% for Singapore. I don't think we're gonna really hit that high very soon. So the spike in US Treasury yields right now, as Fang Boon mentioned, is 1.44%. I don't think inflation is going to hit 1.44% or 1.5% in Singapore anytime soon. But of course, I could be proven wrong by tomorrow. We'll see what because as the GDP reports come out, so on and so forth, and the PPI as well as the CPI comes out, then we have a better view. All right. Okay. What is your take on the rare earth element? Opinion, ideas for investments. Okay, is this a rare earth element thing? Actually, it was in the news 10 years ago. If you remember 10 years ago, the whole hoo-ha was that China had 90% of the market. The mines in the US as well as Australia had already closed down. So China was the one that was controlling global supply, and of course they did something. I mean, they kind of like restricted the sale of rare earth metals to Japan. 10 years ago, then the Japanese were all kind of like very concerned and all that. So this thing about the rare earth metal, rare earth elements is not new. All right. I would say that as an investment play, I'm not sure how sustainable it is. One thing is that from a scientific perspective, right, the rare earth elements, rare earth metal is basically a group of metals, but some of these metals are actually quite plentiful. It's just that the way our economy works is actually cheaper to do it in China. But it's not that they are actually rare. It's just that there are a lot of them in Australia. Australia has got a lot of rare earth elements. So is the US, but it's just not economically feasible to do it, right? Because the way they did it in China, and I don't know whether you've seen some of the photos, it's quite horrifying. Like some of these small mines, right? It's actually manual. You have a guy going in, dig it out. He actually cleans it like using water, using his hands, right? This will never happen in the US because of labor laws and all that. So everything must be high tech, and of course the way they process the metal must be, environmentally sound, and then there's safeguards. That's why it's very expensive to do it in the Western countries. So China is cheap because they don't have sort of regulations. That was the issue. So from that perspective, right, it is not because they are rare. They are plentiful. It's just that it doesn't make sense economically speaking. But you think about it this way: if let's say rare earth elements, metals, become very pricey, very expensive, then of course it becomes more economically feasible to expand the mines in Australia as well as in the US. And then what happens is that supply will go up and then the price will kind of equalize. So this is not something which is very rare and then the price will keep on going up. No, when the price goes up, to a certain point, right, then of course the US and Australia will start opening up new mines, and then the supply will go up and then the price will come down. So the supply is there. It's just that it's cheaper to do it in China. So I'm not sure whether this is going to be a sustainable investment play. All right. Okay. Next. Any thoughts on Disney? Yes, the House of Mickey. Now, the House of Mickey, as you know, has been severely impacted because of the COVID-19 restrictions. So a lot of the theme parks and all those things they didn't, they had to close it and all that. Now the thing about Disney is that you need to understand there are actually three parts to it. You have got the sports channel, ESPN. All right, so in the US, everybody watches sports. So every Sunday there's always some kind of American football or basketball, anything happening, right? ESPN, even before the COVID-19 thing, I think for the last 5 to 10 years, right, they've been losing viewership, all right, because it's like signing up for HBO from StarHub. The whole thing is pretty expensive, right? So what they want to do is, of course, they don't want to buy from the telco anymore. They want to go straight to Disney, yeah, or they go straight to the they don't want to buy, they don't want to watch the game through ESPN anymore. They go through other channels where they don't they don't have to buy the entire package, right? They just buy that particular type of sport they want to watch, and it becomes cheaper. So people have been cutting the cord on ESPN for the longest time. So obviously that has been a downward impact. Then of course the second leg of Disney is their movies. All right, so they've got the big acquisition. So previously they had got their own Disney animations, right? So their own cartoon shows. Then of course they had Pixar. They bought Pixar. They bought Lucasfilms, right? And they also bought the company Marvel. All right, so that's why they've got a lot of these movies going on. And the third leg is of course the theme parks. And of course the theme parks, as well as the movies, have got a separate link. That's the merchandise, the t-shirts, the Lego toy sets, so on and so forth. So Disney, as you can see, right, is basically three legs. The first leg, ESPN, has been going down for the longest time. The second one, the movies, well, they had a lot of very good movies until Iron Man was killed off, and of course, what's his name? Captain America retired, became very old, and then that's why they don't have all these big blockbuster movies anymore. And really, they had a few which were going to show in 2020, but because of COVID-19, they had to postpone it. That's why now you see a lot of the programming comes from the Disney Plus, right? The what you call Falcon and Winter.
Yeah, I think the WandaVision or
WandaVision. Yeah, those things, right? So now they've got that, right? Which is trying to kind of like bypass the cinemas, and you can also watch a brand new movie, by paying a little bit extra and getting it on Disney. So that means the movie is, they're releasing it in the theaters, in the cinemas, but you can watch it also at the same time without going to the cinema, where you do it on Disney Plus, I think by paying $30 or something, I don't know. All right, so they've already tried that once for that Mulan movie, and then they've got another one coming right up, right? So of course the last leg is not doing very well, the theme parks, obviously, right? So I would say that Disney for a long time has been a victim of his own success. The price has been at a very, fairly priced, simply because they are doing everything very well, right? And because of the COVID-19 and all that, not their fault, right? And then that kind of impacted their performance, which means that as the economy starts opening up, then it will be A+. Okay, I think it's a little good that they are kind of going all out on Disney Plus, because I'm not sure whether you know, but in the US, the convention is that they need to share half of their ticket revenue with the cinema chain. So in the US, you've got a very big cinema chain called AMC, right? And the challenge here is that in the US, it is by law, right, that the content provider like Disney, right, the studios, cannot own cinema chains. Right, so because it's an antitrust legislation, they cannot own cinema chains, so they have to go and work with AMC, right? But then when you show a movie, they take half. The cinema takes half. That means as a Disney, I absorb all the costs to create a movie, and when we actually sell the movie and people watch it, cinema, we have to share the revenue. So actually, my profit is not very good. So Disney is actually quite good, because nowadays they don't have all these big blockbuster movies, right? Because people are not going to cinema. So they release a lot of this episode kind of series kind of thing on Disney Plus, and then they collect the whole thing. They don't have to share the revenue anymore. So I think this is going to be a very significant engine to generate profits and revenue going forward. So 2020 was like the start. This year is 2021. But as you can see, they're opening up to more and more countries. I myself am wondering whether I should subscribe to Disney Plus. Yeah. So I think this is going to be a significant revenue generator for them. So as ESPN goes down, they've got their own channel, and they can still pump out content whether or not the COVID-19 restrictions are still on. So I think this is a plus for them. All right. So I wouldn't mind holding Disney in the long run. Okay. So the reflation team. Okay. So all right. So what is this? How should we protect our portfolio against inflation? I don't think inflation is going to be that significant that soon, right? So I think we've got 6 months to a year out, and I don't think inflation is going to hit 1.5 or 2%, that quickly, right? I think the market is kind of getting ahead of itself, and the reason why the bond yields are up is simply because people are selling bonds, right? It's not as if the regulators or the government is saying let's increase bond yields. Let's increase interest rate. They are not actually. It's actually a big problem for the US government because they've got a lot of debt. So if bond yields go up, they actually have to, pay a little bit more money to finance the debt. So I will caution against the idea that we're going to see, normalized inflation anytime soon. I don't think we're that close. All right. How would things play out for the strategic government-linked company if it kept suffering persistent loss, incurring huge debt? Will it be like NOL? Well, NOL is kind of a specific case simply because NOL was in shipping. And as you know, the shipping industry is pretty cyclical, right? So there are times when the dry bulk index, the dry bulk index is kind of like index for shipping costs, right? For like one container, the standard container, that's kind of the shipping cost. So it's it's kind of beholden to the cost of shipping one container from point A to point B. It's just like Shell and BP are kind of beholden to the price of crude oil, right? So it's a very cyclical business. And the other problem with NOL, or rather challenge, right, is that the kind of business is very high capital expenditure, right? So very high asset base, and these are ships and all that. So if you know anything about marine and ships, right, is that there's a lot of maintenance. Generally speaking, you need to pay about 10% of the cost of the ship every year for maintenance. Right? It's very high capex business. So, and of course, you have to spend so much money to have your asset base, and then if it's cyclical, then there'll be times when you'll be out of pocket. All right. So not to say that NOL was a badly run company. I don't think so. It's just that they were caught out, and they were not in the right place when that part of the cycle hit. All right. Or would it play out just like any other regular company like HiFlux? HiFlux was
not a government link company.
How much should we say about? Okay, maybe we shouldn't say so much about HiFlux because obviously the discussions between HiFlux and potential white knights are still ongoing, and in the interest of full disclosure at SIAS, we are kind of facilitating that conversation, right? So we don't want to comment that much, so we should let it play out by itself. But I guess the overall theme of your question, right, is whether government-linked organizations are run well. Is that it? How should we answer this? I think it's specific. No, I think it's case by case.
Yeah.
Right. Because we know, as I kind of commented just now, we have that particular business for NOL, right? And let's take another example, SMRT, right? So we also kind of know what went wrong with SMRT, right? So years of not paying attention to the engineering side of things. So of course the retail side of things was very well done. All this, MRT stations, your tenants, you make money there. But it kind of gave me the idea that the engineering side of things were not, they kind of de-emphasize that part of things, and that's why you have all these technical issues that came out, right? So as you can see, the reasons for each company not doing well are kind of specific, actually. So I can't really see a theme as to whether or not the government-linked organization are inherently good or bad, all right? But I would say that personally, I like privately run companies because as entrepreneurs, is a different mindset, right? Compared to public servants or government employees, right? It's just the brain is wired differently. That's all I can say, right? So I prefer that those kind of companies, right? What do you think, Bamboo?
I think I'm not sure, but it seems like the question is insinuating SIA.
Suggesting.
Yeah, suggesting. So I guess I wouldn't say that it's a badly run company. I think you agree as well. But I think really it's the idiosyncratic, it's the systemic, or rather the macro environment that is resulting in its performance. And I think the government recognizes this, especially we do not have the domestic market to serve, unlike other airline operators across the world. So I think this is the challenge that I think government knows, and strategically speaking, it is something that I guess the government has intent to preserve lah, because ultimately this is a brand that has they have built, and they have made it sort of a market leader in the sector.
So in other words, buy Tesla. Okay, I'm just kidding. This is not a recommendation. Okay, I forgot to mention that whatever we discussed today cannot be misconstrued as a recommendation.
Opinions.
It's just opinion. Okay, next question. Is it time to position for post-COVID vaccination economic reopening? I guess the answer is yes, because the reflation, so-called reflation trade is in a trend, flavor of month actually. So what stocks to buy? I think the companies that were probably going to do well will be companies which were, one, did very badly previously, like transportation, airlines, hotel chains, that kind of thing, right? And also two, companies which are in the consumer discretionary sector. So the financials have already run ahead, and energy is already run ahead. But again, I don't want to talk too much about it, or rather, I personally don't favor energy because it's a bit fickle, right? I mean, the price of energy and all that. So I want something more sustainable. Okay, financials have already run ahead, all right? So that's okay. Then what is still catching up would be the what you call the consumer discretionary, the industrials, the materials, so on and so forth. All right. So you can find a company that in those particular sectors that would be good. All right. Okay. Luco Leisure trading at 73 cents when the exit price is 70. You mean the buyout price, right? So the market price is 73 cents, and what is the exit price?
They're offering 70 cents, but
the buyout, right? The offer, right?
Yep. But they are currently trading at 73 cents.
So 73 is the current last traded price, and then 70 cents is the proposed offer price, right? Okay, the reason for that is what you call event arbitrage. All right. So the market is basically betting that the offerer will up the offer price. Right. So the offer price is 70 cents, but people are willing to buy the stock for 73. So, investors are kind of like, ooh, I think 70 cents is probably opening bid. I think the offer will at some point will have to up his price. All right. So this is what is happening. This is very classic. I mean, it's a classic event arbitrage play. All right. So as an investor, you need to kind of weigh the probability that the offer price will be improved, right? And obviously I guess the market, or at least some investors out there, have kind of bet that will be improved. That's why they're willing to pay 73 cents for the stock. All right. Now I guess this is kind of a hit or miss kind of thing, right? It's kind of all or nothing, right? So if you buy at 73 cents and really they don't improve the price, take your leave it at 70 cents, then you'll be out of pocket 3 cents, right? And again, if let's say they do improve the offer price, I mean, 70 cents is going to go to 75 cents. That's again is, there's some probability to that. So you need to kind of consider that very carefully. For me, that's not my play. Event arbitrage is not my thing. In order to do it well, you need to really go through the financials to kind of ascertain the actual true fair value of the company. If really the fair value is 75 cents, and you offer it 70 cents, then after a while people will not sell it at 70 cents, right? Then yeah, it's like very likely the price will go up. Okay, but you need to be very clear about your math. You need to work it out. The problem is, of course, the expected forecasted revenue and all that is up for debate. I mean, how do you know that 70 cents, 75 cents is correct? Maybe 73 cents is really correct. Your opinion is as good as mine. Okay, I'm just skimming through some of these questions. Okay, so there was one here that I missed out. Understanding of index ETF, it is a diversification and a particular general market trend. Do you trade the trend of ETF, or do you buy dollar cost averaging? I just wait for me. Okay, I guess the whole idea of dollar cost averaging is that you want to hold it for a long time. So whether or not if let's say the price of the ETF drops and you continue buying it, so obviously on the average you'll be paying a cheaper price, right? And the idea is that markets will go up and down, so there's a cycle. The long-term trends that markets will go up, all right? So obviously the STI index today, actually I shouldn't say this, the STI index is 3,000 points, we actually hit that 10 years ago. but if you look at the S&P 500 and the NASDAQ, it's obviously higher than 10 years ago. Really, the STI has not been doing much for the last 10 years. But anyway, I digress. So the idea is that if you hold it for a long time and it goes up and down, but over time markets will go higher. So from a technical perspective, yes, you average out your cost. Now, I wouldn't say dollar cost averaging is a strategy itself. I think it's a byproduct, because you're buying the same product, buying the same investment at fixed times for a long time. So obviously sometimes you go up, sometimes you go down. So you just calculate the average price. All right. But that is not by itself the objective. The objective is to see invested for a long time so that you can collect dividend for a long time, so that over time, hopefully the index will go up and your ETF makes money, and that's how you can get out later after you retire and you can convert it to cash. Yeah. So ETF is a good product for that, simply because it has got built-in diversification, so you're not betting on any particular stock. As Pang Woon had mentioned, the index will always be there. So you've got a company that say went bankrupt, you kick it out of the index and then you put another one in. So the index will always be there, and the ETF, if the ETF issuer doesn't go bankrupt, then of course you still have a product. All right, not to scare you, but there are some ETFs, fund managers that actually went under. Yeah, I mean, it always happens in business, right? But of course, the ETF is, Singapore legislation, and of course in the UK, or in Europe, if it is UCITS approved, UCITS, then there would be safeguards. That means there'll be what you call possibly collateral, and it's ring fence, and they could also use some instruments with hedge, or they can also have got let's say they actually pay insurance, right, so on and so forth, to retain the value of the ETF. So if it's UCITS approved, it's relatively safe. All right.
And go with the trusted brands like iShare, Fidelity, Vanguard, all those big providers, I guess.
BlackRock.
Yep.
Okay. And just to add on, if you want to check out what all those ETFs are, you can simply go to www.etf.com or www.etfdb.com. We're not affiliated with them. They don't know us, we don't know them. It's basically two very good websites, free websites, where it will list out all the most of the ETFs which are listed in the US. So there are hundreds, thousands. Yeah. And you can use a filtering, the tool to filter what you want. So it's a very helpful website to do.
I think you cautioned previously that the AUM figure is a very good indicator. So go with someone or rather ETF that has relatively large AUM.
That's asset under management.
Yeah.
It's like you go to a food court. Yeah, you go to a food court. As Singaporeans, obviously, you go to the shop with the longest queue. You find a shop which has got no queue, then you think that the food is bad. So same . You also want to play in a big casino, right, brightly lit. You don't want to go to some alley and then play with some dodgy guy. right? So, AUM, you want to kind of look at the funds which are the biggest. So like the fund is only 10 million US dollar, forget it. It's very risky. And next question, do you think Sembawang Marine will be delisted eventually, even though it's backed by Temasek funds? Can't say because again, historical precedent is that it has happened before, obviously. Tiger was taken over by SIA, then of course you had SMRP, obviously, so on and so forth. So I guess if it's if let's say the company is trading at a very low share price in the stock exchange, and if whatever sovereign wealth fund thinks that the fair value is higher and it's cheap, so might as well bring it back and privatize it, restructure it. And because once you bring it back in, once you restructure it, it doesn't affect the stock price because now it's a privately held company. So it's actually a viable strategy. And then later on, after restructuring, when the economic situation improves, they can relist it. All right. If you look at Dell Computers, so many years ago, that actually happened. Right. So Michael Dell, with the help of some hedge funds, he borrowed a lot of money from banks. Right? He took the company private. Right. Same for Burger King. Burger King was taken private by a hedge fund, so so forth. So that could happen. All right. I think for Sembawang Marine, I think the focus should be more or less, what's your view on their order book? Because they sell services, ancillary services, and also things like ship tankers and the kind of the oil rigs, right? So people order from them, so they've got an order book, right? Yeah. So that's actually quite a good indicator of strength of business. The people cancel, the clients cancel their orders. How many months is that? Are those orders going to last? Right, so on and so forth. So that could be indicative. Then of course the other one will be obviously oil price. Right, yeah, because the people who buy stuff from Sembawang Marine, those will be the oil majors, right? So oil companies do exploratory work, they need an oil rig or tanker and all that, whatever, right? So it's oil related. Okay. I think oil obviously will go up as the global economy strengthens, right? But I'm not sure that so you see, oil price currently is about 20% higher than February. That's a huge increase in span of only a few weeks. I'm not really sure that's sustainable. Maybe again the market is running ahead of itself. The market tends to do that. Okay. Next, how will credit card companies Visa, Mastercard be affected with more usage on digital wallet, PayPal, and other digital payment? I think the first thing to kind of remember is that Visa and Mastercard themselves also in this space, like digital wallets and fintech and all that. So they have not been kind of sitting still. So they are partners or collaborations and so on and so forth. So I think if the world moves towards a more kind of a digital currency, I mean in China nowadays you don't have to bring a wallet out. Everything you can pay by QR code or your Weixing, just 10 cents, right? Just Weixing the money over, right? So I mean China is kind of a front runner in that. So if the world follows that model, I don't think Visa and Mastercard will stand still. They will adapt, and they have already been adapting, for a long time. It's just that they don't have a like a separate brand, right? It's not like, oh, I'm Toyota, I create a luxury brand called Lexus. I'm still Toyota, right? So they don't really have a separate brand, but they are not standing still. They, for many years they've been doing a lot of things. So I don't think they'll be left behind. All right. That said, obviously, things like your Apple Pay and PayPal and whatever, they've of course taken a lot of revenue from the traditional credit card companies, right? And that's of course a bit concerning for the developing world, because for developing world is, it's actually quite hard to get credit, right? So you need to be a well-known customer before the bank actually gives you a credit card, because in essence the bank is advancing money to you, right, for 30 days. Okay, so for like India and some parts of China, you cannot get credit. So that's why you have all these digital wallets. All right, so in that sense, this Mastercard and Visa, they are actually losing market share, right? Because they're not reaching lower tail of the pyramid. So for the people who cannot get credit, you're never going to offer them a credit card. All right. Actually, the problem is a lot more concerning for Amex. Because Amex, actually, their charges are higher. So if you're a network partner for Amex, you actually need to pay more to Amex. I mean, that was previously, right? So, and Amex is a standalone, or it used to be a standalone brand. Obviously, nowadays, they do work with banks and all that. Like DBS has got Amex credit card, right? Previously, Amex was basically Amex. So I think Amex traditionally, or rather the last few years, has been more badly affected compared to Visa and MasterCard. Anyway, I think was it last month that we checked the target price of Visa and MasterCard? They were relatively high compared to the current traded price. Right. Anyway, I think some of our presentations, our PowerPoints are still on the net somewhere. So if you check, I think that was either in December or January. Yeah.
Previous videos would have those figures.
Yeah, we did have provide some target prices. Okay. All right. I think in the interest of time, it's what is it? It's 1 minute to 8. Maybe we just pick, or maybe if Anggun, you want to pick a question?
No, you can go ahead. Just, what do you prefer?
Okay. There are a couple of questions. Yeah.
How about the one that about EV? So I think
where's that? Any thoughts on new EV companies? Is it?
Yeah, like NIO or XPeng, because I mean you are a big Tesla fan.
Not particularly. All right. I think the challenge with the EV industry right now is that everybody thinks it's some kind of gold rush. Right? There's a whole bunch of companies trying to get in, especially from China. All right. To get into this space. Because obviously Tesla has proven that the business model is viable. So if you got the technology and you have a sexy product, then people will tend to buy it. Okay, so Tesla has kind of blazed the path, and now you've got a whole bunch of companies trying to get into this space. Some will do well, but I think at some point there'll be a consolidation, as it always happens. So this is kind of the trend, especially if a whole bunch of these companies are from China. Everybody will get in, and then there'll be government subsidies, right? Then after a certain level, right, you'll have to consolidate because a lot of them will die out. Okay. The other thing is, of course, I like Tesla, but Tesla may not have the best technologies because I read it somewhere that I think for some of the Tesla models, they use a particular, Tesla is like a sports car, but on batteries, right? But the problem is that I'm not sure whether it's true now, but what I read was that the problem is that after the first few, you can hit the accelerator and go off, right? Like 0 to 100 in whatever,
3 seconds,
4 seconds, right? But you can't sustain it. You can't do that all the time because the battery technology does not provide that burst continuously, right? So the first few times after you charge, you can do that, right? But after you do it too many times, you cannot go to 0 to 100 in such a short time anymore. But apparently BMW has perfected that technology. So whether you floor it now or 20 times, you still the acceleration will be this still just as good because of the battery technology. All right. So I think this space is going to be a lot more competitive going forward, especially if you have got a cheaper, lower price models coming out of Chinese companies, and there'll be a shake-up. So over time, you might find that Tesla is like Apple, very pricey but top of the pile, relatively good technology, very fantastic personality for the CEO and nice styling, and it's a premium product. And then you got a whole bunch of other EV companies, right, which are kind of like kind of thing. So I think that's what's going to happen in the next few years, right? But also you have to remember that General Motors has also committed to phasing out internal combustion engines by the year 2035. So even for the mainstream sedan, family sedan segment, right, they're going into EVs already, right? So I think EVs, given another 20, 30 years, is going to be, you're not going to see internal combustion engines anymore. So that's going to be the thing, right? And so in the new industry, you're going to have Tesla behaving like Apple, and then you got a whole bunch of, others companies. All right.
I think maybe I just add on. I think I read some, on a report saying that it took Tesla about 17 years for them to turn profitable. So I think many of these companies, although they are generating revenue, most of them are still loss-making. And especially, I think the mass market is an untapped area. There's an opportunity, but I think at this point, things are simply too expensive, especially if we consider the supply, the supply shortage for semiconductor chips and all, battery being expensive. It is really hard for them to turn profitable in the near term lah. So that is something, there's a risk to it, essentially.
But still, these Chinese companies' cost structure will be lower than the Americans and the Germans.
Yep. I guess I think it's not as easy to turn into a profitable company. Yeah. And that is something that it seems like a lot of money are awarding companies that are loss-making. So yeah.
Well, the government subsidies, because you want to kickstart the industry, right? And if you remember the mobile handphone industry, your Huawei, Xiaomi, right? It took them years to get to where they are, right? In terms of the functions of the product, in terms of brand awareness, so on and so forth. So for a lot of companies, they'll be playing catch up to Tesla. Tesla is kind of like, everyone is heard about it, right? It's like the Apple is heard. Okay, I think we're already 4 minutes past it. I think we have to cut it here. All right, so thank you very much for joining us this evening. I think it was quite a nice conversation with lots of questions, and hopefully you got something out of this. All right. We do have some closings, like, this one, all right. So from next month onwards, this SIAS session is going to be an exclusive programming for SIAS members, simply because we want to kind of differentiate the benefits for members, right? So we still have got the Monday market review session, which is free for everybody, but this SIAS session is going to be exclusive for members from April onwards. That means this is the last one for the free look period. All right, so we had December, January, February. Do we have one in January?
Yeah, we do.
Yeah, we did, right? All right, so this is like the fourth one already. All right, so from April onwards, it's going to be exclusively for SIAS members. And the next slide, please. Right, and speaking of which, how much is the SIAS membership? So for a very low price of $1 a month, which actually could be quite expensive if you're living in Afghanistan. But anyway, so for $1 a month, that's $12 a year, and that'll be for the SIAS membership. All right. Do we throw in anything like free NPC voucher? No, like.
We throw in once a month session review, so that makes up for the $1 a month. Maybe
you should have a lucky draw for Mr. Gerald's car. I don't know. Right? Don't tell myself. Yeah. Okay, so the membership is $1 a month, and of course $12 a year. All right. And do we have any more slides? Yes. Okay. Regardless of whether or not you all right, so this is a QR code, right? It's really for SIAS members. Basically, it's to get you on the mailing list so that you can have an idea of what's the upcoming programming, right? Events, so on and so forth. And this is for the next session, which is 7th of April. And the next slide. All right, and this is, if you don't want to be a member, that's entirely fine. Again, you can get on our mailing list so that you know what our programming is, so on and so forth. We do have a lot of free events, obviously. And that still is not going to change. All right. The idea of beefing up our membership here is that we want to provide more services, differentiated services. All right. So it's not just this SIAS session. We do have quite a lot of ideas on what we want to do going forward. For example, stock clinics. And of course, this SIAS session is actually quite helpful, but we also want to do it in a more intimate setting, as in maybe you want to share with us your stock portfolio and then we'll opine on it. It's the kind of thing that you can only do if, let's say, you are, I don't know, client of Bank of Singapore, private wealth and all that, and then you get your portfolio manager to sit down with you and go through your portfolio. And we're thinking of doing things like that. But of course, we want to kind of differentiate our product offering. All right, next slide. Yes, and of course, feedback, right? This is the place where you can use the QR code to complain that we didn't give you any NTUC vouchers or feed you dinner and all that. Jokes aside, right? We do encourage feedback. We've got quite a lot of feedback for our previous events, so on and so forth. That will help guide us to calibrate our programming. All right. But again, just in terms of sharing, sometimes we can't act on the feedback because we have feedback that are diametrically different. Like, one feedback is please do this, like going left. Then our feedback, do this with going right. So it's like diametrically different. So we are trying to kind of cater to different parts of the constituent. So don't kind of feel upset if we don't act on feedback. We are trying our best, but sometimes the feedback is like pulling in opposite directions. And so we try to calibrate our product to try and make sure that we get the as much value out of it as possible. Okay, but we do welcome feedback. All right. Okay. Next slide. Yes. So thank you very much for staying with us for so long. This is our 4th SIAS session, and hopefully it was useful to you, especially free-flowing conversations. And this was the whole intent of this particular product, is for you to be able to ask questions in a safe environment without having to run down to your bank to ask your financial planner or whatever. All right. Okay. So thank you very much for your time. And this is where we will end today's session. All right. So have a good week ahead. Any final last words? Famous last words from?
Nope. Thank you. And we hope to see you next month.
Okay. Yes. I was just reminded. The famous last words is, it is a wrap from us at the SIAS studio, to you guys. So please have a good evening and have a great week.
Good dinner.
And maybe in about 2 hours, let's check out how the US market opens, and hopefully my Amazon stock goes up. All right. So thank you very much, guys.
Thank you.